This is Chris Whalen, CPA, and welcome to the Street Level Business Podcast. First, if you already have a question for me, please pause the podcast and call me on 732-673-0510. My CPA firm specializes in business and income tax matters for businesses and families and offers the full array of services you would expect from a full-service CPA firm. As the name implies, this podcast offers advice for those of us working and living at the street level. If you look at your screen, you will see my website and phone number, both great ways to reach me. This podcast is going to detail some tax research that me and my team did, and it's going to try to answer this question: is a monetized installment sale approved by the IRS? So take a look at your screen, and I want to show you what does a normal sale of assets look like. So we have a seller who wants to sell property. It could be a business, it could be assets, and we have a buyer who wants to buy that property or those assets, right? So seller transfers the property to the buyer. At the same time, the buyer transfers some money to the seller. Now, as we all understand, sometimes the seller can have a gain, a capital gain on this. So if the seller is paid 100% in full, then a capital gain would be calculated and capital gains tax paid on the next tax return. I think we could all understand how this works. It's pretty simple to see on the screen, and we understand what the potential tax ramifications are. The next important concept, if you look at the screen, is what if the seller gets paid over time? So let's say that the seller is selling the business for $1 million and it's all gain. Let's say there's $1 million gain in the sale. Let's say the seller gets paid over 10 years, $100,000 per year. So that means that the seller would pick up only $100,000 of gain each year as he receives money from the proceeds from the buyer. So that installment sale idea is very important as we get into this loan monetization analysis that we're going to get into in a moment. So now on your screen, I'm showing you a new image with a few extra steps involved in this transaction that is called a monetized installment sale or loan monetization. So let's take a look at your screen. It seems like we've added a few extra steps, or at least one extra step here. So let's take a look. We have the seller is still transferring property, but wait, it's not going to the buyer who will eventually wind up with the property. The seller is transferring property to this unrelated company C, some middleman who really doesn't have anything to do with the transaction, but usually the seller was contacted by someone in an unrelated company C, usually someone who says they have this great tax strategy that's going to save you a lot of money with the IRS. So now what happens? The property is transferred to the unrelated company C, and unrelated company C does not pay the seller any money at all. They simply give an installment loan, but no dollars are given. This is a very, very important point here. So that means that the seller now has an asset on their books of a loan receivable. And that loan receivable, though, will only be interest. So if you recall a few moments ago, I mentioned when we have an installment sale, when we take in principal dollars, we have to pay capital gains tax on those principal dollars. But we don't pay capital gains tax on interest income. Okay, so now the seller has transferred the property, and now let's see what happens with the buyer. So now unrelated company C, this middleman person who was making probably a lot of money on this transaction, that company then transfers the property to the buyer. Usually this is done within a couple of days from when the seller has transferred the property to the unrelated company C, or it might even be done at the same time. Let's take a look. We're still looking at the middle of our screen, and now unrelated company C has transferred the property to the buyer. Now the buyer transfers their money for purchase directly to unrelated company C. Okay, that seems interesting. So the seller didn't get it, but the unrelated company C got it. So it looks to me that The property was just transferred very quickly to unrelated company C, and so now the buyer can simply transfer money to them and not the seller. Okay, so I hope you're following this and have your thinking caps on. Okay, so now what happens, another company, an unrelated financing company D, is going to lend the seller basically the amount of the proceeds that they had. And within this transaction, all of the professionals or strategists that are suggesting you do this are going to tell you that, oh, those proceeds have nothing to do with the assets you just sold. I want that to sink in for a minute. Any logical person, any business person would say, well, wait a second. Isn't this really just a roundabout way of getting the seller their money? I believe that to be true. Here are some more notes, and these can be read on the memo, actually, that relates to this podcast. There's a clickable link at the top of this podcast if you're watching it from my blog, where you can look at the text version of this. And that's where this text is coming from. Okay. The important thing to remember is that usually any cash you receive as the seller will be taxable at that time. Like many other tax strategies, loan monetization attempts to get the seller 100% of the money they are owed, but not pay any tax on it for 30 years. So you may ask, if they are technically getting the full proceeds from the sale, why do you think they should not pay any taxes for 30 years? That is the exact question the IRS asks. So let's take a look at how the loan monetization strategy chart looks. You will see that the seller winds up in the same cash position, although the professionals pushing this strategy tell their clients to invest those proceeds immediately into a new venture, as if that loan was unrelated to the sale of their assets. But no matter what, for a moment, they were given cash that can easily be considered as the proceeds from the sale of their assets. Is it just a coincidence that those loan proceeds received by the seller are almost exactly the sales price of what they sold? Remember that this seller is put in touch with the unrelated financing company D by unrelated company C, further strengthening the clear argument that this is merely a shell game with players inserted to obfuscate what the underlying facts are of the transaction. This loan monetization is an interesting idea, but another thing to consider besides my notes above is that any installment sale that is over $5 million that is not personal property or farm property incurs interest to the IRS at the current applicable federal rate. Interest is owed on the installment principal outstanding in excess of $5 million. This can significantly reduce the overall tax savings on any transaction. Next to consider is that this is not yet settled law, and the IRS is aware of this and still looking at it. Generally, a monetized loan received on an installment note is considered a principal payment and therefore subject to tax. This particular arrangement gets around that because the intermediary purchaser and the lender in this case are completely unrelated. A few cases have been won using this technique, but in particular, it was noted that the seller had a bona fide business reason to take out that loan. But are these truly unrelated transactions? Is the loan that the unrelated financing company D is making to the seller collateralized by the loan that the seller is holding from unrelated company C? If so, that linkage would worry me. In my opinion, it is very difficult to make these transactions seem unrelated. I hope you can see why, based on my analysis, I came to this conclusion. In one case, the seller invested the proceeds directly back into his business. Some intermediary companies require an investment in new property with the loan proceeds in order to skirt this rule, so you can't just pocket the money from the loan proceeds. In the end, however, the IRS is still looking at the substance over form doctrine with respect to this type of transaction. So it may be a worthwhile option for some. I still feel it can be somewhat of a gamble until final regulations are issued regarding this specific type of transaction. When in doubt, we prepare a request for a private letter ruling, which is a direct request for IRS guidance about complex scenarios. If you are approached by what seems to be a professional and seasoned team with any strategy that looks like this, I urge you to contact me so I can help you analyze the real underlying tax issues and potential consequences. If this team doesn't have private letter rulings and instead give you an IRS memorandum, this is a good indication that they themselves do not have confidence in what they are suggesting you do. Remember, your tax returns are your responsibility, and these seasoned professional teams have no responsibility. A few years down the line, when you are audited and possibly assessed heavy taxes, fines, and penalties, they usually will not take your call. They have long since been paid. One last piece of advice: be sure that these professionals sign an agreement to be responsible for any interest or penalties you may incur due to taking their advice. This brings us to the end of this edition of the Street Level Business Podcast. Questions? Concerns? Call me on 732-673-0510. Thanks for listening. I hope you found this podcast informative. If you want to become a subscriber to my business and tax memos, please send an email to chriswhalencpa@gmail.com and I will add you. Remember, the moment you have a business or tax question is the moment you should be calling me. Have a great day.